the information here, what we know is that the current financial year ended on 31st of May 2010, meaning that that year then started on 1st of June, the 1st of June 2010. Now, if you go 1st of June 2009, if you go back to the additional information note 1, we are told that the present value of the obligation and the fair value of the scheme asset on 1st of June 2000, and that is the start of the first year, was how much? Was 100 million. So therefore, we take the fair value of the scheme or the plan asset as at the start of the year, which was 1,000. Now to this we have said we are supposed to proceed and we add expected return on plan asset, on plan what? Asset. Now this is computed using a rate known as expected rate of return on scheme or plan what? Asset. Always will be given that. If you go to the information which is above the first paragraph there, you'll see that we are given the expected rate of return on the scheme what? Asset, and the first year is 12%. So what we need to do is to get 12% of that, which will give us 120, and then to this we have said we should then proceed and we add the contributions which were made to the scheme, of which the contributions which were made, we have that in that information which we have under the first paragraph, and we can record that for the 3 years. We have 90, 100, and also 110. So once now we add the contributions, then we have said we proceed and we less what? The benefits which were paid. The benefits also we are given that in the first year it was 150, the other year it was 180, the other year it was 190. So we have that. Then once now we have that, what we have said is that we need then to come here and we compute what should be the fair value of the plan asset as at the end of what? And then we are going to compare that with the fair value of the plan asset as per the valuation which was done at the end of the year. So that will give us what? We have 1,000 plus 120 plus 90 plus that is minus 150, and that should give us 1060. Then what we need to do is to compare that with the fair value of a plan asset as per the valuation which was done at the end of the if at all we go back to the question, you'll see that we are given the fair value of the scheme, or basically the plan asset as at the end of the year, which we are told it was 1190. So we need to compare the two. And in our case here, you'll see that we have an increase. Of 130 million. Now, what we have said is that because this is an asset, anytime we have an increase in the value of an asset, according to a valuation which has been done, then always you have said that that increase is an actuarial gain. Gain. Then we proceed to the year 2011. We have the fair value of the plan asset as at the start of the year. Now, the fair value of the plan asset as at the start of this year will be the closing balance in the previous year. So mean that our opening balance there will be 1190, and then we compute the expected rate of the expected return on plan asset using the rate which are given here for 2011, which is 11% of 1190. That will give us to the nearest whole number 131, and then we compute this still. We will have 1190 plus 131 plus 100 minus 180. So that will give us 1241. So then we need to compare that with what is the fair value of a scheme or plan asset as at the end of the year, which is 1372. Now, if you compare the two, then we can be able to see that we have an increase of 130. Still, that will be an actuarial gain. So we go to this year, our closing balance there will be the opening balance there, and then we compute that with the expected rate of return, which is 10% of 1372. That will give us 137 to the nearest whole number. So we compute this, meaning that we have 1372 plus 137 plus 110 minus 190. 190, we have 1429, and then we compare that with the fair value of the scheme asset at the end of the year. So 1188. So if you compare the two, in our case, we will be able to see that we have a decrease. We have a decrease of 241. Now that decrease of 241, therefore in our case, is an actuarial loss. So that's how we compute the actuarial gain or loss in respect now to the fair value of plan asset. Then let's proceed and we compute the actuarial gain, stroke loss on a fair value, that is a present value of a plan obligation, and plan obligation. Now, still in terms of how we compute these, having the format here is very simple, very simple. So we need to have 3 years there, and also we are given our figures in million of shillings, like that. Then we have said we start with the present value of the defined benefit obligation. This is what in our question is known as the present value of the plan obligation as at the start of the year, of which still that is given in the additional information note 1. We are told is the present value of the plan obligation on 1st June 2009, it was 1,000. Then to this we said we add interest cost. Now this interest cost is computed using a rate which is known as a discount rate. Always you'll be given that discount rate, so mean that we get 10% of that, which will give us 100. Then to this we add 2 items. We add the current service cost, cost. In our case, the current service cost, you're given that for 3 years, 130, 140, that will not change, and 150. And then to this we should then proceed and we add the past service cost. Now if you check on that information which we have there, you'll see that we don't have the past service cost. So take into account we don't have that, we proceed and then we less the benefits paid. The benefits paid will be the same, 150, 180, and 190, and 190. And then what you're going to do in our case is to compare that with the present value of plan obligation. Plan obligation as at the end of the year, of which in our case we have those values there. The present value of the plan obligation at the end of the first year is 11. We have 1380. We have then 1408. So let's determine the amount of actuarial gain or loss. Let's first of all we compute that. We have 1,000 plus 100 plus 130 plus 3 is minus 150. That will give us 1080. So we need to compare the two, and basically in our case then we can be able to see that we have a decrease. We have a decrease of 20. So just to confirm that that is correct. So the present value of the obligation at the end of the day is 11, 1380, and 1405. Our interest cost is 100. Current service cost 130, 140. Yes, so we have that. Then meaning that that difference in our case will be the actuarial gain stroke loss. Like in our case here, if you compare the two values, you'll see that we have an increase. We have what? An increase. Basically, I've said if according to a valuation which has been done, the value of variability has increased to an entity, that is an actuarial loss. Is an actuarial loss. So therefore, this being an increase here, it will be an actuarial loss. It will be an actuarial loss. So meaning that in our case we have a positive 20, which is a loss. Meaning that if now we have a decrease, then we have said a decrease will be what? A gain. So let's go to year 2011, we have our opening balance here, which is 1100, and then we compute the interest cost based on the discount rate, which is 9%. We get 9% of that, and that will give us 99. And then we compute what should be the value of the plan obligation at the end of the year. So we have we add that plus 140 minus 180, and that will give us 1159. So then if you compare the two, then still we will be able to see we have an increase. In our case, we have said anytime we have an increase in the value of variability, that is an actuarial loss. So we go to the other year, we have 1380. So then we compute the interest cost at the rate of 8%. So we take 8% times 1380, and that will give us to the nearest whole number 110. Then what we need to do is now to compute what should be the present value of the plan obligation at the end of the year. We have 1380 plus 110 plus 150 minus 190. That should give us 1450. If we compare the two values, then we will be able to see that as per the valuation which was done at the end of the year, we have a decrease. Basically, what you have said is that if now the value of variability decreases as per valuation which is done at the end of the year, then that to a company which is supposed to pay benefit in future, that is a gain. That is what? A gain. So therefore, a decrease there is a gain. And I think having that, then we can be able to proceed and compute now what was required in that question very fast. So in the question here, we are required to compute two items. One, what will be taken to the income statement as the net pension cost, what will be taken to the statement of financial position. Let first of all we start by computing what will be taken to the income statement, or what will be reported to the income statement by the entity, and that is the net pension cost. And still we are going to compute that for the 3 years, 2010, 2011 and 2012. We have said the net pension cost is computed using those 4 components, and in our case here, remember, you don't have the past service cost. So therefore, what we are going to do, we are going to take the interest cost. The interest cost already we have computed that. For the first year is 100 million, 2011 99 million, and 110 million. So in our case, we have said we don't have that. We then take the current service cost, service cost, which is 130, 140 and 150, and then we take the expected return on per asset. We have that expected return on per asset. Per asset is also known as a scheme asset. We have to remember that we have 120, 131, 137, and basically you said this is an income. This is an income, so therefore we offset that from our cost. So whatever you're going to get here is known as the net pension cost, and that's now what will be taken to the income statement. So we have 230 minus 120, that will give us 110. Then we have 99 plus 140 minus 131, that will give us 108. 110 plus 150 minus 137, that will give us 123. So this what now the company which is operating this retirement benefit scheme will be accounting for as what? As a cost. Remember, this, or basically these actuarial gain or losses here, we don't report them to the income statement, and basically that is in accordance with the revised IAS 19. Now if you go back to the question, there is some information which you are given there in note number 2, that additional information note 2, the company recognizes all actuarial gain and losses arising during the year in the retained profit. That information as far as the revised standard is concerned is irrelevant. Is what? Irrelevant, because what you need to note is that according to the revised IAS 19, according to revised IAS 19, net actuarial gain stroke losses, gain stroke losses should be accounted for as part of the other comprehensive income. That is very, very important as far as that question is concerned, because before this standard was revised, that is IAS 19 was revised, an entity had 3 reporting options, or there were 3 reporting options which were given to an entity to account for the net actuarial gain, or basically to account for actuarial gain or loss. Now, those reporting options which were available to an entity, the reporting options which were available to an entity prior to the revision of this standard, one was something which was known as deferred recognition through a corridor approach. Two was a recognition of actuarial gain or losses through other comprehensive income, and also recognition of actuarial gain or losses through the income statement. Those were the 3 reporting options which were available to an entity, of which now the revised IAS 19, it has eliminated the 3 reporting options and currently requires the net amount of actuarial gain or loss to be accounted for as part of the other comprehensive income. So therefore, that's what you need to remember. Then Roman 2 of the question, we are required to compute the item to be taken to the statement of financial position. Remember, what we said here is that what an entity should take now to the statement of financial position is what is known as net defined benefit, asset, or liability. So therefore, that's what we will be required now to compute for the 3 years, starting with the 2010, 2011, and 2012. So what we have said is that we should compare the fair value of the plan or the scheme asset with the present value of the defined benefit obligation as at the end of the year. Now here, first of all, let's take the fair value of the scheme or the plan asset at the end of the year. So at the end of the year 2010, we have that as 1190. The other year it is 1372. The other year it is 1188. Then we compare that with this present value of a plan obligation. Still at the end of the year, we have 1100, we have 1380, and then we have 1408. So in this case, we can deduct our present value of the plan obligation from the fair value of the plan asset. And basically, you have said the difference, we refer to it as a net defined benefit, asset, or liability. So whatever we will be having here is known as net defined benefit asset stroke liability. And basically what you have said, if we have a negative, it is a liability. If we have a positive, it is what? An asset. So in the first year, we take 1190 minus 1100. So in that case, we get a positive 90, meaning that then is a net defined benefit asset. Then in the year 2011, we have 1372 minus 1380, and in that case we get negative 8, meaning that then that is a net defined benefit liability. Then we have 1188 in year 3, minus 1408, which will give us still negative 220. So therefore, what we have here in the first year, this will be accounted for by the reporting entity as a non-current asset. But in these 2 years, where we have net defined benefit liability, this will be accounted for as non-current liability, So that what was required in that particular question there, whereby we were required now to compute items to be taken to the income statement and also the statement of financial position. Now, what is very, very important in that question, and what as a student you need to remember, is how to account for this net actuarial gain or losses, because you'll see some questions talking over something known as a corridor approach, Still, that question there was talking of recognition of actuarial gain or loss through retained profit. Now, what we have said, and what is very, very important, is that the revised IAS 19 has removed these 3 reporting options which a company had to account for the actuarial gain or loss. And what we have said is that currently the net amount of actuarial gain or loss should then be recognized as part of the other comprehensive income. So therefore, that brings us to the end of our class, whereby we have managed to look on the issues to do with the employees benefit. We have defined what are employees benefit. We have looked on the various types of employees benefit and how we account for the 2 types of post-employment benefit plan, that is defined contribution plan, the defined benefit plan. So therefore, we stop at that point. We meet in our next class.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.